Hi all, this video is going to run through how to complete the exercise 7.10, which is all about recording transactions in inventory cards using either the identified cost or FIFO methodology of inventory valuation. This is going to be a bit longer of a video because it's a bit bigger of a question, so let's delve right into it. Here we have a business that is Third Dimension Print Supplies. And they have one product called an AP540 printer. Now they use the FIFO method, but we are going to do both. And there has been 7 transactions that they're asking us to record. And in part A, they're going to ask us to record this using the identified cost method. We'll talk about that in a second. And then we are going to do the same transactions assuming the FIFO assumption. After that, we are going to delve into C, which is going to then think about what the inventory ledger and cost of sale ledger would look like using identified cost. So that's quite a lot. Let's have a step back. The identified cost method and FIFO are 2 methods for valuing inventory and recording inventory coming in and out in our perpetual inventory system. FIFO is going to assume that the oldest goods are sold first, or oldest goods go out first. And identified cost means we know which one is coming in or out. Now, before we record in our inventory cards, where we're going to record inventory coming in and out, I consider there to be 3 rules of recording inventory movements in inventory cards. And if you follow these rules, you can't go wrong. Firstly, number 1, we will record the inventory at cost price. So inventory coming in and importantly out is the at cost price. We don't record GST. So if the information has GST, we're going to have to exclude it. And when we list our inventory in our inventory cards, we're going to do our oldest first. Okay. There is also an assumption that we follow FIFO identified cost, whatever, we need to follow their rules, and we will do that as well. Now, if we go to the 1st of July, we have our first transaction. We are told we start with 6 printers in the inventory with a cost price of $300. So for this one, we are going to write the date. We always write the date of the transaction, which is the 1st of July. The detail here will always, unless it is this type of transaction, we will write the source document. You might notice there is no source documents here, and that's because we're recording the balance. Now, this transaction doesn't involve more or less inventory coming into our business, so we don't include it in the in or out column, but we just say we are starting with 6 that cost us $300, and hence we have $1,800 of inventory. Now this one is the same for both FIFO and identified costs. So in the interest of time, I'm going to do both of them at the same time. But we're not going to do that for any others because I don't think that is a good way to demonstrate these 2 questions. But for interest of time, we will do it for this one. And I'll do my very best to make it legible, but it is a little bit tricky because it's quite fiddly. We will then move in to our July 4 transactions. And in this case, we have sold 2 printers for cash for $540 each plus GST of $54. So we'll recognize that this, for our identified cost, it occurred on the 4th of the 7th. Our details is always our source document. This will be our receipt 65, and you shouldn't be abbreviated, but I will for the sake of it. And then we go, do we have more or less because of this transaction? And we of course have less, and 2 have left our business. And this is where we need to recognize we need to follow our rules of inventory, recording inventory cards. We wouldn't say out of 540 because that is the selling price. We record the cost price. And even though it's identified cost, we haven't been told which ones have been sold, but we know it must have been the $300 ones because they were the only ones we had. So 2 of the $300 ones have left our business, $600 of value, leaving us with 4 of the $300 ones left with a value of $1,200. And if we were doing just one of them, I think it's a good use to tick off that transaction and move on to the next. And I really encourage students to not look for shortcuts. You just do transaction after transaction. We then move to our 8th of July transaction. And in this case, we've purchased on credit 10 printers for $3,200 plus GST, and it's on an invoice. So we will write the source document, invoice 9211. And then we realized because we purchased them, we have more than what we started, and we purchased 10. Now we record them at cost price, but we will record them at their unit cost. So if we bought 10 for $3,200, we must have bought 10 with a unit cost of $320, and we get our $3,200 in our valuation there. Now, in our balance, we don't say 4 plus 10 means we have 14. Remember, we must list our oldest first, and we list the values separately. So we still have the 4 of 300, which is $1,200, but we now also have 10 $320 printers for $3,200. You can see I haven't included the GST in any of these transactions, and I've recorded them just at cost price. I then move on to the 14th of July. And here we sell one printer, and its cost price was $300. So I'll underline that. We're going to do them a bit quicker. This was also an invoice, and the invoice is 322. But because we sold, one comes out, and we've been told it was a $300 one. So it's not because it was the oldest one sold, it's just we know that this one was the one that was sold because of the identified cost, meaning that we now have 3 of the $300 ones left, being $900, and we have 10 of the $321 printers left. We then move to the 24th, our next transaction, and we donated a printer to the local school. If we were asked to do our debits and credits, this is a advertising transaction because it says donated, and we have had one leave, and it happens to be a $320 one. You might notice it's a memo because it is a internal transaction. So we'll write memo 32. One has left our business, and it was a 320 left our business, and we now have 3 of the 300, so 900, but we now only have 9 of the 320, meaning $2,880. We then move to the 28th. We'll go through some of them a bit quicker now because I think we're getting the gist of it. The 28th, we made a sale. 4 printers left our business, and they were the $320 ones. So we will now say receipt 68 to 71. We will write that they were all the 4 were the $320 ones. That is $1,280 of inventory leaving us with still the 3 that cost us $300, $900, but we now have only 5 of the $320 ones, leading to $1,600. We then come to maybe the harder transaction. We have a stock take, and we found that we had 3 of the printers left, and 7 printers left, I apologize. And when we do our count here, you might see that we have 8. So we instantly go, I have lost 1. I have an inventory loss. So I'm going to do the 31st of July. This is a memo. We haven't been told the memo in this transaction, but we can have a guess because the previous memo was 32. We'll call this 33. 1 has left our business. It has gone out. And we are told we have 3 $300 ones left and 4 $320 ones. Identified costs, we can work out which one we have lost. We thought we had 5 $320 printers. We have 4. It must have been the $320 printer that we lost. So $320 of value has left our business. That would be our expense for our inventory loss if we were doing our debits and credits, leading to our correct balance of three $300 ones of $900 and four $320 printers costing us $1,280. So there we have done our inventory card for identified cost. We now move on to doing this via FIFO, where we're going to ignore the part of the question where it says cost price or which one we know has come in or out. Sorry, which one is going out, because we will assume we don't know this. We are going to assume the oldest goods are the ones that go out. Okay, and we know they're the oldest ones because they are the listed ones that are first. So on the 4th of July, for our sale, we sold two. We are going to, well, I'll still do it, but we recognize that the source documents and the details won't change. Here we have two come out, and these are our $300 ones because they're the only ones that we have, same as identified cost, leading us to four $300 printers being remaining. We then come to the 8th of the 7th, the 8th of July. In this transaction, we purchased 10, invoice 9211, and this one doesn't change either because FIFO is relevant for when things leave our business. So 10 come in at $320, $3,200, leading us to four $300 ones, $1,200, and 10 at $320, $3,200. And if you've watched my video for this 12 minutes, you're going, there must be a quicker way. I feel like I'm doing the same thing. And it does become repetitive, but there is no shortcut. You will make mistakes if you try and look for shortcuts and do it, two transactions at a time. So you'll notice that that's not something that I will do, even though we do want to try and find ways to be really quick at this. On the 14th, we sold one. So we have this for invoice 322. We sold one, it has gone out. And then the question, which one have we sold? We will assume, even though it says cost price is 300, we don't know that. We will assume our oldest one is sold first, even though we have two different prices. And our oldest ones are listed first, and that is why it is the $300 one that leaves our business, leading us to having three $300 printers and still having 10 of the 320. So even though in this transaction, identified cost and FIFO had the same answer, it's a different methodology. I didn't know it. I'm just assuming the oldest one is left. On the 24th of the 7th, we donate a printer. So one goes out. But again, we assume it is the oldest one that is being donated, leading us to two $300, $600, and still having 10 of the $3,200 printers. And you might, for those keen eyes, realize this is where the first time something has changed. We assumed, so when we did identified cost, we knew it was a $320 printer. This time we don't know this, so we have to make an assumption, and it is our oldest one that has left our business. So it is less accurate than identified cost, but it is a valid assumption, and we'll talk about why it might not be possible to do identified cost in part D. On the 28th, we sell four printers, and we did know that these were the $320 ones, but this time we don't know that. So we're going to go receipt 68 to 71, and we're going to go, which ones have we sold? We will sell two of the $300 ones, because they are our oldest ones. We don't have any more of them left. We still need to find two more. They were our $320 ones, because they're our next oldest ones listed. So $640 of value leaves, leading to us to now only having 8 of the $320 ones, $2,560. We then come to our final transaction. We know we are losing 1. We have 7. We now have 8. The 8 are only the $320 ones. So it must be the $320 one that has been lost. 320, leading us to 7 of the $320 printers left with $22,040 of value. Now, importantly, FIFO inventory losses, the rules, we assume that the oldest goods are lost. We don't have an option here. We only have 8 at the same value. But if we pause there, we've accurately done our inventory cards for identified cost in FIFO. And you will note there is a difference. In FIFO, we assume that we have 7 of the $320 ones. The more accurate reflection is that we actually still have 3 of the $300 ones and 4 of the $320 printers. Now, if we followed there, you might have a bit of a stretch. That's taken about 15 minutes. We've successfully followed the rules of recording inventory and inventory cards. Part C asks us to just do identified cost and to update the ledgers. So remembering we are now going to follow Paler and the rules of debits and credits, but we're going to use our inventory cards and knowledge of the transactions to do this. Okay, so first things first, we will recognize for our inventory, we started with a balance, and this occurred on the 1st of July. And if we take a step back before we do that, I think it's a good use of our time to spend 30 seconds to think about what type of ledgers these are. Inventory is an asset and cost of sales is an expense. Now, if we think it through then, assets, when they go up, will be debits, and debits are left, and credits are right. So if we know something goes up in inventory, we'll record on the left-hand side, and if inventory goes down on the right-hand side. Cost of sales, if our inventory is an expense, so if our expenses go up, we'll record it on our left-hand side, and if it goes down, which it won't because expenses don't ever decrease, that would be a credit. So we have a bit of the tools to do it. We're going to start with the 1st of July with our opening balance, which we know we don't write individual unit costs now. We're assuming that this is the only product that we sell. We have $1,800 of inventory starting off, and then we look at the information. We're following just our inventory card for identified cost, and outs are going to reduce our inventory. So anything in the out is going to reduce it. Anything in the in column is going to increase it. So the 4th of July, our first transaction, we have inventory going down, don't we? Because and in the out column, and the value is 600. So we can write 600 in our inventory column. It has occurred on the 4th of July. And then we go, what was this type of transaction? This was a sale, which when our inventory went down for our credit, the debit would have been cost of sales, which I'm doing a bit of an abbreviation for time. And this gives us a clue that this is a transaction where we need to record our inventory going down in our cost of sales inventory, and our cross-reference here is going to be inventory, and it will occur on the 4th of the 7th. I can't write the 4th of the 7th because something on my computer is blocking it, but you should write the 4th of the 7th there. We then move to the 8th, and the 8th occurs, something comes into our business, doesn't it? $3,200 of inventory. So $3,200. This occurs on the 8th of July. And this was a transaction with an invoice. So if we look at the 8th, we purchased on credit this inventory. So when this inventory went up, our credit would have been our liability of accounts payable increasing. And remember, our cross-reference is where we link the transaction. On the 14th, we have $300 leaving our business due to a sale, again, an invoice in this case. So we're going to write 300 on the 14th of July. Our cross-reference is cost of sales, and we then, of course, also put it down on our cost of sales ledger, and we'll do that on the 14th of July. On the 24th of July, we have $300 leaving our business again, so we can write that on our credit side, the 24th of July. But this was due to a donation, so inventory will go down, not because of drawings, not because of a sale, but because of an expense that isn't cost of sales, but advertising. Because you remember, if we are doing a donation, we might be getting some publicity, and the mechanism that we put in is that we have an expense of advertising. On the 28th, we again have inventory leaving our business, $1,280. This occurs on the 28th of July. And this again was due to a sale. This was a cash sale. We don't have to recognize this in terms of our cross-reference because we are just recognizing the expense component. So again, $1,280 is a new increase of our expenses on the 28th of July. Again, our cross-reference being inventory. Now, our final one on the 31st, we again have an out column, so again, a reduction in inventory. This one was due to an inventory loss. So on the 31st of July, our cross-reference would have been inventory loss because that would have been the expense. Now, because our cross-reference isn't cost of sales, we don't have to update that one. And we've actually accurately updated our ledgers, but it doesn't say anything about balancing. I always make the assumption if it doesn't, we should. And particularly if the question says for all of the transactions for the month. So for our inventory account, we are going to balance it. We add up both sides and add the biggest on both. 5,000 is bigger than the total of our credits. We then have to put the difference above the line, 31 on the July, the difference. So how do we get these numbers to add up to 5,000? We have to add 2,180. You would use your calculator. Balance. And hence, below the line, we are saying that we are starting with $2,180 of inventory. Now, the keen eyes would notice that 900 plus 1,280, which is what we're saying we're ending with, is actually 2,180. Okay. Now, cost of sales is an expense, so we actually don't need to balance it. We would foot it, and we would close it, but we haven't got to that yet in the order of chapters, but we would be closing this, and you will learn how to do that. So I won't do that just so we don't confuse people, but we have done our ledgers. Now, in terms of Part D, I am just going to talk to this because we've run out of room. Explain why the management of some trading businesses might decide to use FIFO to value inventory rather than identified cost. We go through that in a few other worked example videos, so you can look at them in a bit more detail. But the keen eyes might have gone, FIFO is not the accurate one here. Sometimes we were doing something in FIFO, like recording the oldest ones leaving, when we knew it wasn't the correct, more accurate reflection of the business. So why would a business adopt FIFO rather than identified costs? There is two reasons generally, and this is why obviously the question says, implies that you want more than one. Firstly, it may not be physically possible to identify the cost price leaving of the goods leaving. This could be due to all the goods being jumbled together. A good example is I use petrol in a petrol tank. It can be bought at different cost prices, but it gets mixed up. So when someone fills their car up, the petrol station will not know which petrol has left their business. So it might be physically impossible. The other reason is management might use FIFO because they believe that the cost and the time to adopt identified cost will be too costly or time consuming. for example, putting barcodes in on price tags or having that organization is going to take time and money to set up and to manage. And it's important to recognize that FIFO is a valid assumption. Many businesses use it. Even though it is not as accurate, it is perfectly acceptable to use. And that is the reason. Now my bell has just gone off in the background, so I'm going to stop this video, and I hope this has helped you work out, you follow the rules of recording an inventory cards, helped you practice a general ledger, and you've become an expert at FIFO and identify cost.